From Sattva Knowledge Institute, this is Decoding Impact, the podcast where we apply systems thinking in conversation with extraordinary experts to understand what it truly takes to scale solutions in the social sector. Decoding Impact is hosted by Ratish Balakrishnan, a co-founder and managing partner at Sattva. Welcome to today's episode.
According to official data, there are 6.3 crore MSMEs in this country. 99% of these MSMEs are micro-enterprises, which typically employ less than 10 people. These MSMEs are creating 11.1 crore jobs, which is only next to the agriculture sector in India. However, the MSMEs in India are plagued by acute shortage and access to formal credit. According to a 2018 IFC report, the total addressable demand for MSME credit is at 36.7 trillion rupees, with a total supply of about 10.9 trillion rupees. There is a potential addressable credit gap of about 25.8 trillion rupees in India today. The answer to this problem of this scale is not going to be more boots on the ground. In this podcast, we will explore how technology solutions, such as the Open Credit Enablement Network, addresses and enables access to credit for MSMEs in India at national scale. We speak about OCEN itself, the engagement with the lenders, the credit products, the distribution engine, and finally, the role of philanthropy in accelerating its adoption. To have this conversation with us, we have Mr. Hrushi Mehta. He comes with over 20 years of experience in finance and credit and is currently the Chief Evangelist of CredAll and a volunteer with Icepert. Hrushi, thank you so much for joining us today.
Hi everyone, thanks for having me. We've always tried to solve this problem of getting credit to the underserved, and MSMEs in India, particularly underserved because of the ticket size, right? It's very easy to serve larger ticket sizes because you can have a lot of manual intervention, but it doesn't become economically viable to do that with the smaller ticket sizes, typically when it's 3 lakhs and less. So we have to solve that problem with technology. And throughout my career, that's what I've been trying to do. And I think OCEN finally solves the problem. And so, taking a keen interest in trying to roll that out across the ecosystem and finally, put an end to that problem of getting credit to the MSMEs, especially the ones who are underserved. So CredAll is a non-profit foundation that basically manages the OCEN protocol, which are basically a set of APIs that enable lenders and loan service providers, and loan service providers are basically the platforms where the consumers sit and transact. They could be like food delivery apps, they could be, agri-trading platforms, they could be implementations like the government e-marketplace where, or e-commerce platforms where a lot of trade happens. So what CredAll does is manages these APIs and then co-ops the ecosystem. And in at least, the initial role is to evangelize it across the ecosystem and get people to start participating. And what participation means is basically get lenders to adopt the APIs, consume the data that comes from the LSP and the account aggregator, which is another, India Stack platform to enable the transfer of consent-based bank statements and GST data. So what we do is we co-opt the lenders to adopt. We help them, give out the first few loans by framing the credit policy. And on the other end, we also create the first reference app. So we've done Gem Sahay in partnership with the government e-marketplace, and we are currently in the process of testing GST Sahay, which is invoice financing with SIDBI. And these are like the first reference apps like Bheem was to UPI. And eventually, we'll also include private market apps. Our role as CredAll is also then, once we've co-opted these guys, also to create ecosystem, rules of engagement to make sure that it's fair for everyone in the ecosystem. It's not overbalanced to one side of the player. So we also do that. And we'll eventually have a governing council where we bring the market players on to help frame how the ecosystem will evolve in the future.
Got it. I want to unpack a lot of the things that you said, Hrushi, but before we do that, What OCEN is, which is the Open Credit Enablement Network, for me is part of a larger journey that India is taking. It started with Aadhaar, then UPI, as you talked about, account aggregator, etc. And it's not just different tools. This is a different way or a paradigm to solve for financial inclusion in India. A lot of people who are listening to this podcast may not be aware of that entire journey that we have taken. If you can just step back and talk about what that overall big picture is and how that comes together, and then if we could get into OCEN, that'll be much better.
Yeah, sure. So, the genesis of all this actually is the UK Sinha committee report. Now, that sounds, obviously quite boring to most people. It's a bunch of people who came together to frame how we'll get credit to MSMEs. And this happened, 5-7 years ago. So, while it might not seem apparent, because these changes have happened over almost, the better part of a decade. And we just see the end result of it, right, as the public at large. But there are 3 things we had to solve before we could implement OCEN, right? So one of the major challenges is manually verifying in person, because anything manual is a cost. So Aadhaar eKYC actually solved for that, because you could remotely now and reliably address the KYC as far, it's not completely solved, but it solves a large part of the KYC problem. The second piece is UPI. It is cost-free transfer of money between 2 parties. And this is particularly important because we had this hypothesis of trying to facilitate an intraday loan, which is, about 500 rupees. And that was like our end goal, and to do it in real time and completely paperlessly and presencelessly. Now, the challenge is if, a 0.5% or 1% is charged each way transferring the money, that is more than the interest cost on the loan, right? So UPI was the next layer that was put in place. The third layer was the account aggregator, which launched in September 2021. And what this facilitates is consent-based data sharing between an FIP, which is usually a bank, and you can share your bank statements to a financial information user, which is the bank that you're applying for a loan to. Now, this is consent-based, it's purpose-limited, so there's privacy involved as well. And we'll soon be adding, GST data and other sources of data, like even asset data, over the next few years. And this becomes, the foundation, because to underwrite, for MSMEs particularly, you need 3 pieces of data: GST data, which is like a proxy for your turnover and your business inflows and outflows. You need bank statement data, which gives you cash flows. And these cash flows are basically an indication of whether that turnover actually materialized into cash. And then the third piece is repayment information, which is sourced from, like if you've taken credit previously and whether you've repaid it and what your current leverage is. And that is sourced from the credit bureaus. So that data layer is very important, because if you want to give unsecured credit, because MSMEs have basically been served collateralized credit because people were so risk averse, and plus there was no other way to assess their credit worthiness, and hence collateral was asked for. So what we are saying is the data becomes collateral, and your reputation, your what you've done in the past enables you to get credit in the future. So those were the 3 layers that we needed. And then finally, one of the major problems was you have, MSMEs now, we've become a digital India where you're transacting on Amazon, on GEM, on Swiggy, Zomato, Ninja Card, wherever. But you're not really, like if you want credit, you have to go elsewhere, right? You'd have to go to another app, or you have to go to your bank or NBFC to raise credit. So the hypothesis here is, what can we serve credit at the place where the user is transacting, which is, that word embedded credit. And they can literally, just how they check out on payment, can you check out with credit very quickly in under 10 minutes, right? So what we developed, and there's a massive other challenge, is that when these loan service providers, these platforms that the users transact, integrated with the lenders or vice versa, there was always bilateral integrations, and there was always customization, which slowed the process down or limited it, because some would be willing, some would not. So what we've done is we've standardized that, and that's become the Open Credit Enablement Network. So what you're basically doing is creating a standard language, standard process that a lender and a LSP can communicate with, and then they have to integrate with this only once, and they don't have to do it multiple times. So drastically reduces the cost of integration, makes everyone interoperable. And basically, our hypothesis is that it will serve credit to multiple places more quickly than people engaging bilaterally.
Brilliant. I want to, in my words, just sort of summarize three things that you said, each of which I think is very, very important. The first thing that I understood from you is, which is the very, very first principles way of looking at credit. Right? For thousands of years, credit has worked in the following way, which is, do I know you? What is your reputation? How can I give you the money? Right? In informal networks, it's people giving cash because there is social trust. Today, what you're saying is that all of these three can be done digitally. Do I know you? Yes, I know you because of KYC and Aadhaar. What is your reputation, which is really where account aggregator comes, where a financial information provider can, for a particular context, give that information to another financial information user to know that this person's credit worthy. And transfer of the money can also happen digitally with UPI. And again, this is super simplified, but at a fundamental level, these are the three big pieces of credit, which I think over the last 10 years we've started putting in place, which sort of gives us the environment to be able to move forward. I'm sure you're going to tell us in reality how there are still chinks, etc., and we'll come to that. But the second thing that you said, which is very, very important, Hrushi, and I would like you to build on that, which is this idea that bilateral connections have already been made. And just to give you my background, I used to work at SAP. And a lot of what we used to do is to say, how can I work with banks? How can I work with people, large companies to create these networks more effectively? But they were all very proprietary networks, our own protocols, our own definitions, and so on. And that the cost of integration is very, very high. Because a lot of times people come and ask, is OCEN a platform like Amazon? But OCEN's not a platform. It's not a technology. But you use the word protocol in the beginning. Maybe you want to tell us a little bit more about that. If it's not a physical platform, what is it and how does that create and unlock value?
No, so it is and isn't a platform, right? So I'll explain what that means. So one is creating the language that the LSP and the lender talks, right? Standardizing that. The second is the ease of integration, and that we are creating what we call a OCEN gateway, which sits in between the LSP and the lender. And it is what both have to integrate with once, and then they don't need to integrate with anybody else, right? So the protocol is the language and the platform is the gateway. So it's both. We don't, it's not a platform like where people, like an Amazon or a Gem where it's a complete, you can do multiple things. Our role is just to route applicant requests to the lenders, send back offers, and then the lender takes over once an offer is accepted. So there's a distinct difference, in the two, and both are required to make this successful, because if we just had the protocol, then people would still have to have bilateral integrations, which is what we want to avoid.
Absolutely. And when there are 6.4 million, or 4 crore MSMEs that we're talking about, they're going to be distributed across multiple places. You named some of them in the beginning. There are people, associated with Zomato, with, a Ninja Cart, etc. So finding that common language or protocol is helpful, but the gateway is actually still the infrastructure that we need to actually transact.
There are software service providers that sit in the middle of these LSPs and lenders today. Now, the thing is, they will still have to customize to lenders, to LSPs to make this real. Now, as a public body, we are able to study this and then sometimes convince, sometimes cajole and push people towards the standardization, which maybe private players are not able to do. Say you're trying to build an expressway between two cities, right?
Right.
If private players built their, those expressways, they would charge a massive premium for people to use it, and that would crowd out some users, right, who couldn't afford it.
Right.
And it would reward the deep pocket, basically. But if, the government went and built it and charged a very, very low toll gate to use it, it suddenly becomes usable by everyone. And that traffic then creates economic activity, right? So the thinking is no different than that. It's just that, people think of infrastructure, something you can touch and feel, but this is digital infrastructure that enables the same outcomes that physical infrastructure sometimes does.
Absolutely. And in some sense, this is the rails on which all the trains run, right? But establishing the rails is very, very important. And the third thing that you touched upon, Hrushi, which I think is also a very important part, which is the fact that Today, there is business happening online which leaves a digital trail, like a Zomato with the restaurants and Ninja Cart with the providers. That digital trail is extremely helpful for us to build on, because you know that this person's actually getting orders, not getting orders, who this person is. Is that something that you're seeing? You talked about GEM as well, which is, of course, the marketplace that's set up by the government for B2B procurement. How important are these digital marketplaces to the story of OCEN, and how are they enabling this entire journey?
One of the two main players, right? So one side is lenders, the other side is these LSPs. So if you think about it as an upstream, downstream thing, first the transaction happens, then it is likely to show up on GST, then that transmits into your bank statements. So it's like an upstream to downstream flow. Now, what you're doing is if you're able to tap the data upstream, it becomes that much easier for a lender to be able to lend, right? Because see, we call it benchmark data. One is data to be able to underwrite, and the other is benchmark data, which sits with these platforms. And what that means, let's take a food delivery app, right? So they know which restaurants are in which quartile in terms of business, how many orders they get, who is more heavily trafficked than others, and that sort of thing, right? That information becomes very, very important to a lender, because they get a sense of when there's a cash flow crunch, what kind of product to create. So for example, if say restaurants are running out of money by the 10th of a month, and they need money for 10 days, because on the 10th is typically when restaurants pay their staff as an industry practice. So it's a big outflow. So they need maybe 10 days bridge capital till, their business starts, till the regular flow of business replenishes their cash flow. So maybe then that's the product you do. And what you can also do is enable daily collections, because sometimes, cash flows through the platform that is providing the service. So you could actually create like an escrow mechanism. So it actually provides additional safety for the lender. So you're giving safety to the lender to underwrite, and you're giving credit, like bridge capital to the restaurant to be able to survive till their cash comes in without having to do it at, the money lender rates. You're doing it at bank rates, which is a lot more affordable.
Then there is disbursement that comes in, but your business need might have changed in the meantime, and then you probably have a very different problem. With OCEN, we are saying that the product can be big, small, whatever, because it's suited to the needs of the restaurant, number one, and it's built ground up based on what the restaurant actually needs. Two, you don't have to submit a lot of documents, go to a ton of places, ideally, because the data around your behavior is already there with the LSP. Three, the value, the loan can be fairly quickly delivered, and to you, depending on this checks and balances being okay, right? So much more relevant product, much less hassle, faster delivery. Would that be a fair thing to say?
See, in this completely manual mode you described, the costs of doing all these things cost anywhere from 3,000 to 5,000 rupees. What if I wanted a 5,000 or 10,000 rupee loan? This would not be possible, because when you say restaurant, it's not always like a big franchise or whatever, right? It also could be literally your chaiwala. Now, if he wants like a 10,000 rupee loan, this becomes unviable. Even if he takes his bank statements, now a guy making maybe 20,000 rupees a month or 30,000 rupees a month will not be filing GST. There will be nothing to file there. But even if he takes his bank statements and goes, the challenge is, the first step is, can I trust these? So other than the fact that, even the 10,000 rupees is not viable because I to do so much manual work. The second piece is, can I trust these documents? Because anyone can manufacture them, right? They need to be verified. They've not come straight from the source. They might be stamped by the bank, but there's some assessment that needs to be done. Now, so there's a fraud risk. Then, it's not viable to give. So there's no interest. So usually, and the other thing is, when bankers want to hit targets and incentivize behavior, right? I want larger ticket loans. Why should I do these? They have to be automated. So basically, one is the costs are too high. There's incidence of fraud because it's submitted by the user and not directly from the source. And third, if it's not automated, it just doesn't make sense to do, right? Now, what OCEN does, the only person that is interacting with the technology is the user themselves who are looking for a loan. Everything else happens automatically at the bank's end. So suddenly these become viable to do. I don't have to talk to anyone. I just submit all my documents. The data comes straight from the source, digitally signed. So there's no real need to worry about fraud. And, the disbursals also happen post the various steps of setting up repayment, signing the agreement, which is signed by an OTP or e-sign, and then finally disbursing the loan. So if it's all automated, you've got the sunk cost of the tech, and then the few costs, the low cost of like sourcing the data or whatever other things that you are doing, and it becomes suddenly viable to do, right? So automation is the key. Getting data from trusted sources is the key to be able to making this work.
This sounds like a great idea, Hrushi. So why don't you give us a sense of where you are today? And it'll be great to break it down on where are you with the lenders, where are you with the products, and where are you with the actual customers and the distribution?
So we started last year. So, 18 months ago, it was still an idea and we were working towards making it real. So it launched in May 2021. And, we started with one lender. There were obviously chinks in the tech, and we ironed that out. Now, so, with Gem Sahay, which is purchase order financing, we have 6 lenders. So 2 large banks, 4 NBFCs. We've given about, 10 crores in loans, about 2,500 loans by volume. So it's about 40,000 rupees in ticket size. Smallest ticket size is 160 rupees, incidentally. Largest ticket size is about 5.5 lakhs. And the NPAs are about the 3% range, which is actually not bad at all for this segment. Particularly because it's going through that learning phase currently. We also have 8 banks in the pipeline. So, we ran the pilot. So we'll have in maybe like 4 months, about 14 banks. And we'll also have, a couple of public sector banks shortly. So the first step was to build out the supply side, because first the lenders have challenges with tech because there is no manual work, so everyone has to build the tech to be able to do that. Secondly, the issue is with the credit policy, right? Because this is not a mature product like, say, retail loans, which has been being done for 15, 20 years. So that has sort of been figured out by lenders, but this needs to be figured out. So they're initially very, very cautious. Sometimes don't give loans for weeks, then they, ease up the credit policy, then a few loans go through, then they see if they come back, then, they slowly ease it out. So this is that learning phase. And, Gem is a smaller first pilot use case, right? And even when I say small, it's almost 25 to 30,000 crores of GMV. So, when you're talking at a country level, even a pilot is quite large for a country like ours. And, we've catered to only 10% of the Gem sole proprietor, the sole proprietors sitting on the Gem platform. And we'll now soon expand that to a larger base, because we want to run a pilot to a very small section.
Maybe I'll just try and make sure that I understood the first one correctly. In Gem Sahay, Gem, as you know, is as everyone knows, is the government e-marketplace. When you said invoice financing, what you're saying is that a particular government department places an order to one of the proprietors who's registered himself in the Gem platform. And when they place an order, against that order, you're able to provide this person credit to satisfy that order.
So the stated challenge on Gem was that MSMEs are not able to take on larger orders because they don't have the liquidity to finance the fulfillment of those orders. So I've actually heard a few of them say, now that this facility is there, I will start accepting larger orders, which is exactly the point, right? Because if we can generate more business for them, that means more economic activity, which means the credit has solved. We've solved for what we were trying to do with that credit being disbursed. So it's purchase order. So you're right. It's the government entity is buying something. They put out a bid. They put out a tender. These guys bid for it. Once the bid is won, then they go and finance the purchase order to be able to fulfill it.
And given there is assured payer on the other side, the credit risk here is very, very low, because you're paying against something that he's assured to pay as soon as the delivery is done.
That's right, because we managed to trap the cash in these cases. The major part of this is delivery risk, actually. We have an escrow mechanism to trap the cash when it's paid. The risk is, will the person deliver? So that is where the Gem data helps. In the past, if you've delivered on time in high quality, you haven't had too many rejections, that is actually a signal for the lender to take that, okay, I can fund this guy, whether he's large or small, because they are delivering on time.
Absolutely. This goes back to the point of reputation that you made earlier, that the reputation is assured based on past behavior, which shows a certain level of consistency. Brilliant. Yeah, now you're talking about the second reference implementation.
Yeah. So the first reference implementation was this purchase order financing. The second one is invoice financing, and this is particularly e-invoices on the GST platform. See, the challenge is currently the supply chain financing happens from invoices on ERPs, or the other version is threads, which has been quite successful. But even with those, so one is ERP invoices, can become fraudulent if people just manufacture data. The other issue, I mean, with threads, the issue is it's a two-sided, like both guys have to say that the invoice is real, like they accept that the invoice is real, and then credit is disbursed, and the person who's on the hook for payment is the buyer. In our case, what we are saying is, because it's a GST invoice, because you've agreed to pay tax, you might even have taken input credit against it. Like, why would you have done that? Okay, now you can argue that you'd create a web of companies and try to do fraud in that way. But see, we're not solving for the 0.5% who'll, defraud the system. We're solving for the 99.5% who'll use it well. So basically, those invoices don't need to be verified because you're paying tax, otherwise you wouldn't file that. And you'll lend against that. So the PO is more upstream, the invoice is more downstream, right? Because you've already delivered the goods. Now you're just waiting for the payment to come. So we finance those, and that is one of the major stated issues, right? Like, I have an invoice, but I never get paid on time. It could be anywhere from 2 to 10 months before I get paid. So can we provide finance for that? So that's GST Sahay, and that's in testing. It should be any day now that the first loans go out. And once they do, we've built that in conjunction with SIDBI, and SIDBI is going to be the first lender. And then we'll open that up to other lenders, and all those 14 lenders that are on GeM Sahay eventually will come onto GST Sahay as well.
And I think the point you're making which is very important, is the fact that we are looking at a generational change here. This is not a game that we are playing for 1 or 2 years. We are playing this for a period of time, which fundamentally changes the behavior or the infrastructure that we have to provide loans for millions of people. And you're right that there is going to be learning along the way. I want to exemplify what you said now, Hrushi, because for the people that are listening to this podcast, this particular use case is important, and it sort of leads to the next 2 questions I had for you. So if I am an artisan working in rural India, I make these beautiful carpets, for example, and I get I get an order, I have to spend a significant amount of money, but I get paid like 90 days later, which always creates cash flow problems. My life is going to get better in 3 ways, if I understand you right. The first way is I get associated with a marketplace that's an online marketplace. And the online marketplace, at the time of getting an order, either on my purchase order or on my invoice, is able to give me a credit so that I actually have access. In this case, it's a purchase order. I'll get access to credit as I'm part of this online marketplace. So for a lot of the rural artisans, this becomes a motivation to actually start integrating themselves into existing online marketplaces, B2B, B2C, B2G, etc. The second is I find, maybe an existing financier or somebody else who's able to, the post-bank model that you talked about, where I'm actually, somebody comes in, is an assisted model. I'm getting access to my loan because I have an UPI, I have my bank statements, and I get access to that. And through auto debit models, money goes out of my window, and that then builds credit history for me to take more loans. This is the second way I can sort of get this access. The third way, and I wanted to check this with you whether this is viable as well, there are existing, NBFCs, microfinance institutions, etc., that are targeting the rural community, but taking a large feet-on-street model today. Do you see them either immediately or in the near future moving to digital, where the SHGs, for example, and all of those other rural communities that are banking in the microfinance model, taking to this approach as well?
Let's just take a step back, right? And I'll highlight the concerns of banks and NBFCs, and then I'll address the question that you're asking, right? So NBFCs have a concern that, look, before we could do stuff digitally, banks couldn't. Now you've standardized it and they just have to plug in. How will we compete with their cost of capital? One. Second, banks have a concern that I have this distribution, which I've spent probably millions and billions of dollars on. NBFCs don't. Now you've made them completely digital and they can move faster than I can. How will I compete? Now, like the whole submission is, first, there's a whole segment out there. Like, we are not only talking about a slice of the existing pie, which is a small slice. I'm saying there's a whole other cake, like as large as retail lending there, that is unaddressed. So I don't think the concern should be, is a piece of my slice going to get taken away? The concern should be, how do I get a slice of the other pie which is lying there? Now, to answer your question, especially if you're in microloan and you're using feet on street, why are interest rates so high? Because the costs of servicing these are high. Now, if we've digitized everything and you can give the same loans at as low as 12%, why would someone pay 24 and 36% annually, right? So if you don't get on this, and look, people might say you're overly optimistic, and I'm obviously could also be called prejudiced because I'm sitting and doing this. But the very fact of the matter is, if digital reduces the cost, if you don't do it, you're already a dinosaur.
And there is going to be this FOMO, right? Fear of missing out, saying if somebody started it, then all it needs are a few pioneers and then everybody else is going to follow.
If one or two large NBFCs, and we experienced this, to be honest, went live, started giving loans, people didn't expect them to take this leap into this new tech. Suddenly, you have 5 or 7 NBFCs saying, now we want to participate. Incidentally, not an hour ago, Kotak gave its first loan on OCEN. That is huge, at 12%. Now, where would an MSME get a 12% bank loan for a 97,000 rupee order? That wouldn't have happened in the normal course, right? So, this is like a huge deal, and this will cause now others to want to come and participate because they've just done something which no other bank in the country yet has done.
So I'm going to just flip the coin now, Hrushi, because we are talking about OCEN by itself, but one of the things you mentioned, which for me is stuck, is we are creating an ecosystem for providing credit to the poor, and we are sort of building the road as we are walking on it. And there are probably parts of this road that is not built yet. Where we have some parts we don't. So if I had to ask you, what are some of the challenges that you're seeing today, and that needs to be addressed either at a policy level or otherwise? It'll be great to hear that.
One of the challenges to drive adoption, but it's not such a hard one because people see the logic of doing this. So the execution challenges in that context are not that hard. What is harder is the credit policy challenge, is the first major challenge. So what happens is, this is path-dependent thinking. People are used to doing things in a certain way. We are not incentivized to take risk, especially in corporate India, right? Because suddenly, if you have higher NPAs, that is, not compared to a mature product. To invest in that, to make mistakes, like mistakes aren't rewarded. Like startups will reward fail fast, innovate, but the larger players won't. So one is creating a culture of that. And I think what happens is, the seniority buys in, right, from the CEO level. But what happens is the executioners obviously are reticent sometimes about doing this, but some of them come around, and what you need is one or two to be excited and push it through with support from the seniority. And then, the others start participating as it follows through. But it sometimes takes months to get a credit policy right before, the first loans go out. But again, so I actually keep reminding myself that, look, you're building for 30 years. So if it takes 6 months, don't worry about it, because once those people enter, then they'll never leave, right? So that is another issue. And then the final and the big one and is like KYC norms, right? Now, what has happened is, look, we have, I think, one of the best regulators anywhere in the world. But what has also happened is we have all these new digital tools now that are coming to life as we speak, right? So regulations tend to be static and the market is dynamic, and sometimes the separation between them grows. So what has happened is, and without getting into the nuances of, what that challenge actually is, look, basically, if you're trying to do a completely digital KYC, then you should have a clearly specified way to do it. Or sometimes you need multi-ministry help to make digital documents available. So very simply, see, Aadhaar solves for retail, like the individual. now you have to get 2 additional documents to prove, that the entity is linkage to the individual, and an activity proof. Now, the challenge is a lot of these documents are not available digitally. Then that breaks the flow, right? Because one is I can't get it at all. Secondly, I might have to download and then upload it. Then it's not a smooth, just a few clicks flow. I can't tell you how helpful the government has been in trying to solve these problems, but they're not easy problems to solve. So whilst they might take, a particular amount of time to solve, I think once we do solve them, it will be solved for those 15, 20 years to come. So that is a major challenge to unlock credit. It's almost like a bottleneck, right? Because some banks are very, very walk in 10 feet inside the lines of the regulation. So then it's very difficult, right? Then you're limited to who you can lend to and are these documents available. So our job is to lay the rails, say what we think would be the right thing to do, and then hopefully we'll be able to get the right tools in place where we maintain the sanctity of the KYC, but using the new digital tools that are available.
Let me take a step back here, Hrushi. So one, you're talking about fraud where I am receiving a loan and I'm the person who's committing the fraud. Yeah. Let's flip it the other way around. I am, there have been recent cases where online companies, in the pretext of selling a product, sign people up for a loan, out of which they can't get out of.
And that is an ecosystem player behavior issue. And I'll come to that. So CredAll will solve for that. So I'll come to that last. We talked about fraud, then consumer behavior, and then let's talk about ecosystem player behavior, right?
Got it.
So the second piece is consumer behavior. Now, the thing is, when it becomes available on tap, you also have to provide education. In 2015, I had gone on a route walk with Arohan in Calcutta. And when people were being given the first loans, before the loans were dispersed, they would keep saying, "Lena hai to dena bhi hai, lena hai to dena bhi hai," because a lot of people, assume that you're just giving me money, I'll take it, and I don't really have to pay it back, and then that creates all sorts of issues, right? So I think there will be some education that we will need to do as a collective, right? Whether it's the account aggregators when they're telling people that you're sharing data, it's the lenders themselves when they're lending, sending educational material, and doing that general education. Maybe we'll take on that role as well at some point, where you, in conjunction with the RBI, say, look, this is all happening, but you are able to get credit easily, but remember that you have to pay it back, and paying on time makes a big difference to how you can access credit in the future. See, that takes effort. It's not going to happen overnight. We saw the same thing at the credit bureaus initially, where credit was being given, and then people were like, "Oh, I didn't pay it back, and now I'm not getting a loan, or my directorship is being affected," or sometimes even in some cases employment was, because employers, especially where people are in financially sensitive positions, want to make sure people are not indebted or have any reason, to commit any fraud. So that's a behavioral thing which will take education and time to solve. And then the last piece, which is, how people behave in the ecosystem and duping. Look, we are going to create, and that's our role as well, is create minimum guidelines, right? On how a product should be displayed, what information should be displayed, how it should even be ordered. So you don't want to make it in an overly bureaucratic where there are too many regulations and then you choke off any innovation. But you want minimum where the consumer at least is being able to make an educated choice. So, if there are people burying it and just, and then suddenly you have a loan which you didn't even want to take, those display criteria those will evolve. So we've set some light criteria currently, but obviously if we find that it's becoming a problem, we'll evolve those as an ecosystem, because, the thing is, we are CredAll and Sahamati, all are formed by public interest people first, and then the market is co-opted. So we'll hold on to that ethos as we go down, the timeline as well.
You touched upon this idea of credit policy a few times in the conversation today. In UPI, the mandate is that there is no additional charge. It's 0% charge. You have to sort of use it. How are you looking at this entire business of credit on top of, OCEN? What sort of guidelines, rules are you going to put in place? How much is it free will of the market, etc.? Just help us understand that better.
So see, with the lenders, we don't prescribe what the interest rate should be or processing fee should be. But what we've already seen is, money is not free. So you can't, and everyone has their own cost of capital, so you can't prescribe what they should charge, but they'll have to charge what the market accepts, or they'll get no business, right? So what we've already seen is people reducing processing fees, almost to the extent in one case where the lender saying, I don't want a processing fee anymore because I have no processing costs other than the tech setup, which I can include by adding a few basis points to my interest rate. So that we've already seen that change, and it's so early, right? But on the lending side, other than that, like, let competition take care of it. But I think what your more pertinent question is the LSP side of it. Like, how do they make money, right? So today, they're paid a bounty. So it's either lead fee, conversion fee, some combination of it. But that also inflates the cost of capital for the borrower, because see, eventually the borrower pays. It's like, not like the lender is going to absorb it or the LSP, right? Because they're making that money. So what we have decided to do is, like, to change the agency, where we tell the LSP, why don't you charge the borrower? See, because these are all pre-approved loans. You'll know if you go through the process, you'll get it. So pre-disbursal, why don't you charge them, 0.5%, 1%? And it's very easy for a loan service provider to test what this fee should be for maximum throughput. You can provide it for free, like some saying, like, I don't want to charge anything because it increases my GMV. So why should I charge anything? I'll just, if my GMV increases, I make enough money anyway. And the other thing is, we're not prescriptive about how you charge. You can even say, I'll charge you a subscription, and the loans can then happen. I'll charge you an annual subscription, monthly, whatever the case, or even loan by loan. All we are saying is, prescriptive about that, like how much to charge or how to charge. Just charge the borrower, not the lender. So our hypothesis that will bring down the cost of lending for the borrower when this happens.
So I want to move to the last part of the conversation that I wanted to have with you, which is really, this is massive. And you said one thing just now, as you were explaining, that this is a set of people who have the right intent to be able to solve a problem where they're co-opting market. And another stakeholder who has the right intent is philanthropy, And I recently was in a conversation that I moderated among people from the fintech space. And there was a lot of thought on what philanthropy should do or shouldn't do to make this happen, because sometimes bad philanthropy can skew the market, create subversive incentives and so on. In this case, given where we are right now, what is the role that philanthropy can play to push this forward?
It's a very good question. So it's, we have been approached before because you're a non-profit, and typically people expect that, non-profits need money to survive and that sort of thing. Now, our initial hypothesis is that, we want to make this self-sustaining via membership contributions, and these membership contributions will be minuscule, compared to the business that it'll generate over the years. The other ethos is also we need a self-sustaining ecosystem where everyone is making money and, they're nourishing themselves rather than needing outside oxygen, so to speak, right? So I think where philanthropy could help is actually providing a time-bound credit guarantee or interest subsidy, especially for loans that are given off the OCEN and account aggregator rails. Because what this will do, like I was describing, I must have said it 3 times in the conversation, that credit policies have to evolve. Corporate India is risk averse, it takes time. So if we provide them a credit guarantee, and that can be worked out what that looks like, it provides air cover, so to speak, for a time-bound fashion. It can be 1 or 2 years, where it gives them time to figure out what the credit model should be. And after that, it can be taken away, right? So what you've done is, it's actually a low-cost way to spur the adoption of these new digital credit rails. And this may not even come home to roost, right, in terms of a credit guarantee. And on the flip side, for a double squeeze, is what you could do is provide an interest subsidy to the borrowers themselves. Now, that is a, clean subsidy where you're just giving money away. But both are equally powerful, because then there'll be incentive for people to come and take these loans as well, right? And, we could help facilitate this, obviously. But I think that would be very powerful to drive the adoption and at least speed up the process of adoption, both on the lender and consumer side.
And I want to build on your credit subsidy idea and throw another idea there to see if this resonates with you, and you can tell me whether this makes sense. On the credit subsidy idea, one of the thoughts that, as you were talking, I was thinking is, there is a gender lens to this work, there is, while we assume that the technology does not understand gender, there's probably a high chance that men take these loans more than women. They're part of these value chains and so on. If we were to create a gender-specific incentive, which is to say, hey, if you're a woman entrepreneur taking a loan, I'm going to give you a credit subsidy. and encourage women enterprises, which automatically then creates women jobs, then creates impacts the labor market overall of women participation. Can we think about models like where these subsidies are actually targeted subsidies that get people who might not otherwise come by themselves, because of the upper heave of the market, but need some additional nudging to come in? And because there is today a significant philanthropic interest in just getting women to be better entrepreneurs, create more jobs for them, and create more businesses for them. And I was wondering whether that resonates with you, or do you think I'm missing something as I'm thinking of it?
So look, I've had this sort of conversation before. Now, when we build credit policies, right, it is never that if it's a man, give a lower rate, or don't give if it's a woman. Like you've almost never seen that. You might see that for professions, or areas, which, I mean, it's debatable whether that should be the case, because it should be based on your individual performance and not like a performance of a collective around you. But, see, the thing is, as we're thinking about this, whilst we understand women have been underserved, maybe that's more like a cultural thing, but that has also changed. So if you look at credit bureau data, there are a lot more women in the last decade who ended up taking credit, also because there were a lot more women in the workforce. So like the thing is, why in my mind would you penalize someone, for their gender? And I understand the concept of wanting to encourage women entrepreneurship, but why not offer it to everyone? Like they all have the same problem of not being able to get credit. So and there's a different argument of saying, okay, if I provide subsidies, maybe women will do business, but then it also gets into that murky area of like a man telling his wife that you take the loan in your name because then, I get it cheaper. So, I mean, those could pan out in any number of ways, but like I would like still stick to the, because at least my experience tells me that gender doesn't matter. I would just provide it to all because it's as needed for like men as it is for women, because it's not like they are getting credit either.
You're right that more women are taking loans, but we've done the analysis of at least the Mudra loans and where women are taking loans. They take the smallest unit loans yet. Right? There's absolutely no graduation that you see of women taking higher loans, even among those that are actually taking loans. So it'll be good to sort of look at that trend. That's number one. And two is, I feel like there's a difference in changing the credit policy and to providing a time-bound incentive on top of it, a subsidy on top of it, where the core policy does not change, which is a lot more higher in the system, but there is a time-bound incentive that's provided to encourage behavior. How it plays out, what form it can take, if we do it like that, we don't know. And as you rightly said, the more we do it, the more we learn. But it'd be great to see if there are actually, positive behaviors and deviances that come out of this, or as you rightly said, unintended consequences because of what we are doing. We talked about, improving customer awareness and telling them about what to do. The line that you said about, lena hai to dena bhi hai, type of a conversation is usually where nonprofit organizations that are already working with a set of people have been very effective, which is that they have social trust. So, they're able to change behaviors in whatever form, but they're also able to do some of this work, which is field building work, which is where philanthropy is funded, awareness related work. But a lot of their work has also been, critique where it's due in non-scalable. It's been too people intensive, and hence, there is a lot of awareness, but it doesn't result in a lot of action. I wonder if there is a way where we can marry the two, where the field building awareness work and the community trust and the social capital they have can be combined with the ease with which technology enables this acquisition, to actually see if at least the initial hurdles of both the behavior awareness and the onboarding can be supported by existing organizations that are working with thousands of such MSMEs or individuals who don't have access to credit.
No, so you're absolutely right. And I'll give you why I'm saying this. So I tested actually 300 to 400 Gem Sahay users as we were testing the app to make sure it was good. So it was done virtually. But like the sense that you got, right, is that people were afraid of the tech, that how do I use this? What does it do? And have questions about it, to the extent that we were actually thinking about instituting some audio-visual assistance into the app. And then, there's only a certain amount. We've done the quantum leap from 2 weeks of no credit to 10 minutes of getting credit. So we're like, leave something for the private sector to do. But you're right, because that socialization that I felt that they wanted someone to help, because basically what we've done is built almost the best-in-class technology for the bottom of the pyramid, and sadly they're not used to that. The more affluent usually, will experiment with technology, try it, check it out, curious to find out. I think that the bottom of the pyramid actually is afraid of it. So it would be very helpful if people actually walk them through it and talk at scale, right? So, yes, we said in the beginning that manual intervention doesn't help, but maybe to get the ball rolling and for people to embrace. And what happens is once they use it, so I started realizing that my telephone number was being circulated on GEM support groups, on WhatsApp group, because people, if they wanted help, they'd start calling. So I realized that, at the end that was a mistake. But this is what they want, to talk to someone, right? Initially, once it's figured out, it's a self-propagating thing, because they need the credit. So then why wouldn't you recommend it to someone else?
Absolutely. And I mean, I'm sort of taking the lesson from, a recent project we did where we provided ready-to-use edtech solutions that are actually designed for people from underprivileged backgrounds, gave it for free to about 5,000 people. The activation rate was 17%, which is that they spent less than 5 minutes on the tool. When we got a nonprofit organization just to actually nudge them to use it, it moved up to 81%. And out of those 81%, people started using it for more than 2 hours a week, which is actually way more than what we thought kids will use edtech for. And what that needed was that initial jumpstart, to actually get them off the fear of what it takes, help them with the interface, and then say, okay, this is your daily behavior. And once that the hop was crossed, it was a lot easier for them to then adopt that behavior and make that consistent, and that is with education, which is not a fun thing to do for kids. And this is credit, which is actually very, very necessary, So there is an inbound pull that's much harder.
Everyone wants the credit. It's just a question. They're not like, it's almost like amazing to them that your phone pay milega. I don't have to talk to any banker and I'll get choice, because they're used to being run around, right? Or not being, treated like an affluent person would be. And here it's like, what? I'll have money in my account in 10 minutes. And sometimes it's almost like, how is that possible, right?
Hrushi, this has been a fascinating conversation for me. I think we've covered a lot of ground, and in my mind, I think as I'm bringing this to a close, what I'm thinking is really that over the last decade and more, we've started putting the pieces in place. The e-commerce companies, the online companies are coming in place that are bringing in a lot of Indians who might not have been online, from delivery boys to restaurants online. We have brought in the critical infrastructure, the digital infrastructure that we need, including how to know somebody is available, how to know somebody is credible, how to transfer money to people. Now we're building on top of that rails like this, which are OCEN, which makes possible a more specific conversation on this more foundational infrastructure around credit. And if we are able to solve for discussions that we talked about, some of which are, the policies and the things that have to be in place, and the other is trust and behavior change, I think this provides us a way to provide just the right amount of capital to the right people for us to spur the economic engine. And you're in a great place to be able to see this happen live, but it's fascinating to actually, sort of put this all together to see how it all gets connected. So thank you so much for your time, Hrushi. This has been great. I hope you enjoyed the conversation as much as I did.
Look, you live and breathe this, and sometimes the progress is very slow, especially when you're a private sector guy building a public good. Things don't, move as fast as you sometimes want, and, even when you're impatient. But like the end result of when it actually happened, I mean, the feeling is like your fulfillment is like nothing else, right? Because it's a very high impact work. So I'm happy to talk about it, and thanks for taking the time to listen.
You have been listening to Decoding Impact. To learn more about Sattva and Sattva Knowledge Institute, please explore sattva.co.in. We invite you to like, share, and subscribe to Decoding Impact so you never miss out on new episodes. Thank you for joining us.